We have unbelievable amounts of debt right now. U.S. GDP is growing quarter over quarter at 3%, but the outstanding debt relative to the federal budget deficit is about 6% of GDP. So we're behind the curve there too. Total outstanding debt to GDP is about 124%. So these levels are absolutely unsustainable. They've been growing and growing mainly over our entire lifetime. But at some point, you're going to just see that ratio change because people are going to realize that their money's not worth anything anymore. And I think really that's what you're seeing in the gold market and the mining indexes and so forth as they start what we think is going to be an extremely exciting and bullish move to the upside.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. Today we have a fantastic discussion lined up, and we're fortunate to have with us STEVEN HOCHBERG. STEVEN is the Chief Market Analyst for ELLIOTT WAVE International. That's the largest independent technical analysis firm in the world. ELLIOTT WAVE International covers every major financial index around the clock, and many of the publications have won top awards in their categories. STEVEN's analysis keeps subscribers ahead of the trends in U.S. stock indexes, as well as global indexes, bonds, precious metals, the U.S. dollar, and the economy. He's one of the world's foremost experts in ELLIOTT Wave forecasting and is a sought-after speaker interviewed numerous times for his market views by Barron's, Bloomberg, CNBC, MSNBC, and so many others. STEVEN, thank you so much for joining us today.
Well, Gary, thanks for having me. Appreciate it.
Yeah. So let's begin with your analysis on what is the current state of the market psychology, herding behavior, and what you think the social mood is.
Right. And you've hit on the main points of what we do at ELLIOTT Wave International, which is not to just look at what the Fed is saying or maybe what the statistic of the day might be, but we're actually looking at the psychology of investors. And the model we use, the ELLIOTT Wave model, looks at this psychology and notices that it's patterned in a fractal manner, meaning that there's self-similar patterns as people get more optimistic and the market gets higher and more pessimistic as it goes down. So in our estimation, we're really at the upper reaches or the endpoints of an optimism that has been building over several years now. And even if you look at anecdotal evidence, like headlines, in newspapers and so forth, and we look at more specific indicators when we look at our waves and so forth, but even anecdotal evidence, you can see people are super, super bullish right now. Now, that's not necessarily a bad thing, but it simply means that you're coming to the end of a trend, and that trend is about to change and move in a different direction. It would be the same way when there's extreme pessimism. Prices will be low, and you'll be coming toward the end of that trend. So the market in psychology moves back and forth in this natural progression, and our job is to kind of find out where we are within that progression, and it helps us see something about the future.
So when specifically as it pertains to herding behavior, I'm assuming that was in big tech, that was in the S&P, but are you starting to see some of that beginning to shift, peel away a little bit, and maybe the herd leaders starting to head in a different direction?
Right. Herding can occur in all aspects. The most famous of the recent ones is probably the Magnificent Seven, where those 7 stocks were driving the market and everyone wanted to own them. But we've seen instances of herding in, say, Bitcoin previously, which to us is just another name for the NASDAQ. I mean, we've actually done an overlay of the price of Bitcoin over the U.S. stock market, and it's amazing how closely they reverse and trend together. So it tells us the same psychology that is at work in stocks is at work in Bitcoin also. But yeah, we're starting to see this extreme in psychology in basically everything in the market. start to turn very slowly now. Now we haven't had absolute confirmation we're at the top, but it really looks like we're getting very, very close.
Interesting. So U.S. non-farm payrolls, the actual number came in at 254,000. The forecast was 150,000, and previously it was 142,000. U.S. average earnings year over year came in at 4%. The forecast was 3.8, and the previous was 3.8. U.S. unemployment came in at 4.1. The forecast was 4.2, and the previous was 4.2. These statistics do not really present a compelling argument for the Fed to cut rates, yet they did. In your analysis, why the Fed cut and why they cut 50 basis points, and will this prove to be a mistake?
Yeah, so what's kind of interesting is that one of the models that we use to predict what the Fed is going to do is simply to look at the trend and direction and levels of the 3-month U.S. Treasury bill and the 6-month U.S. Treasury bill. And when they get too far out of line from what the Fed is doing, the Fed follows the market. The freely traded market sets the interest rate, and the Fed eventually comes along and follows. So we actually made a prediction that the interest rate cut was going to be 50 basis points this time. And the reason we did it very simply is because the 3-month and the 6-month T-bill had been falling sharply, the yield on them, and the Fed was way behind. They're either too loose or too restrictive, but they weren't in line with the market. And we saw this, for example, in 2007, when the Fed was chasing the market all the way down. 3-month and 6-month T-bill yields kept falling and falling and falling as the market was falling. Fed was behind the curve the entire time. So we look at interest. We look at the statistics you mentioned because I think they're interesting, but they tend to be a lagging indicator, and the market tends to be the leading indicator. And that's what we look for when we're looking for, say, government action, because government is usually the last to act on a trend. So we were actually expecting an interest rate cut, and they're still. What's interesting is the Fed is still behind where the 3-month and 6-month T-bill yield is at this point in time. Now, where that will be as we approach the next meeting, we'll have to see. But they're still behind the curve, and they tend to be always behind the curve as the market moves. So what I would say to your listeners is if you're interested in what the Fed's going to do, simply concentrate on what the freely traded market rates are doing, and the Fed will eventually line themselves up with that.
So, Stephen, do you see the situation that the FOMC members are in as such that they would prefer to cut interest rates too much, too quickly in order to minimize the risk that, let's say, unemployment can go much higher? And if so, doesn't this increase the risk that inflation starts to move up again?
Well, inflation could move up again over the short term. Eventually, it's going to all lead to deflation. And the reason it's going to do that is because we're in a fiat-based economy and we have unbelievable amounts of debt right now. U.S. GDP is growing quarter over quarter at 3%, but the outstanding debt relative to the federal budget deficit is about 6% of GDP. So we're behind the curve there too. Total outstanding debt to GDP is about 124%. So these levels are absolutely unsustainable. They've been growing and growing mainly over our entire lifetime. But at some point, you're going to just see that ratio change because people are going to realize that their money's not worth anything anymore. And I think really that's what you're seeing in the gold market and the mining indexes and so forth as they start what we think is going to be an extremely exciting and bullish move to the upside.
So are you anticipating a large deflationary impulse, or when you speak of deflation, are you seeing just a steady slide in purchasing power degradation, et cetera?
Yeah, I think it's going to start out as a steady slide where people aren't going to really realize it that much. And then, like all trends, they tend to accelerate into a panic point where the trend ends and reverses. So I think we could get some inflation over the short term. That's certainly possible. But with the debt levels we have, I think the ultimate end game as we go forward is a deflationary environment, as we can't service all the debt that we have outstanding. We're going to have to do something about that. And defaults and bankruptcies and restructuring, not even defaults. That's all a very deflationary event. I think that's the ultimate end game down the road for our economy and for the markets.
So, okay, so the bond market continues to move in the exact opposite direction of the Fed pivot, right? So the
Right.
so the 10-year yield has sharply risen since the Fed lowered interest rates a few weeks ago. So borrowing costs for us are higher, for them is lower. But in your analysis, why is the 10-year yield rising here? And are rising yields in the face of a Fed interest rate cut a sign that the bond market is starting to revolt? And I have one more piece I want you to talk on here in this answer is gold used to get crushed by moves like the 10-year has had, but it's not anymore. So do you have thoughts on why that is as well?
Yeah, I think people, and it's not even written about in the media at this point, but it will be. But I think people are slowly starting to realize that the bond market's in control and we cannot service the amount of debt that's outstanding. And so when that happens, people are going to demand a higher rate of return of interest to compensate or give themselves a cushion for the prospect that they may not get paid back the principal amount for lending to the U.S. government. Now, it's like people can't understand that. They're saying, what do you, it's the U.S. government. Of course, you're going to pay their debts. Well, there comes some point where the debts get too big, or the outstanding debt gets too big. We simply aren't producing enough and don't have enough money to pay it. And when that happens, I think it's slowly starting to dawn on people. You see gold taking off, silver, I think it's going to have a huge move, and rates are shooting up because people want to be compensated for what they view as an excess risk for buying long-term treasuries.
So, Stephen, this 10-year is correlated often with the mortgage rate, and mortgages are moving in the opposite direction of the Fed rate cut. A lot of folks were, especially realtors, were expecting, this to be the pivotal moment when the mortgage rate was going to drop down and people were going to come back off the sidelines and start buying again. Sales are at historical lows, or, the equivalent of something in the 1970s. Housing is super unaffordable. What are you expecting here with, with real estate, with house prices and house sales?
Yeah. So, real estate really is a local type of environment. So it's going to be different in different parts of the country. But on a very broad basis, if you're buying real estate as an investment, I think it's a horrible time to be putting money into real estate on an investment purposes. Now, it's different from a utility purpose where you're living in your house and so forth. The other interesting aspect of this, or corollary, is that when we had the meltdown a couple of years ago in the market, and real estate was in trouble, a lot of private equity and corporations came in and bought up housing, individual houses, and are renting them out. In the Atlanta area where I live, it's been huge. I mean, a lot of Atlanta real estate, single family homes are owned by private equity and corporations. And we're finding that as they dump that supply back into the market, it's going to have effect on prices. Not only that, but the houses that they're dumping back in are not the most well kept up house, as you can imagine. When you own a portfolio of 1,000 houses, you're not going to, the water heater breaks and so forth. So, real estate as an investment, I would stay away from at this point, particularly based on the liquidity factor that you need to keep that house going. But if you're in a house right now and you're living there and that's your place of domicile, fine. But there's other areas to invest in that I think are going to get a better return than that.
So if a home was purchased for, let's say, $450,000 a few years ago, and they put it on the market for $450,000 and they can't sell it, and they drop the price, and they sell it at, let's say, $300,000 or $325,000, doesn't that reset the market for that specific, we'll call it subdivision or town, based on the comps? And then that type of thing has a tendency to spread. So, the longer this goes on, are you seeing a deflationary impulse in the house prices coming?
Yeah, absolutely. And you hit on the key point right there. It's all about comparables. So, if you're in a subdivision or an area and all of a sudden someone drops their price for whatever reason because they have to get out of here. Well, all of a sudden your comparable now where you thought it was 400,000 is not 400,000, it's 350 or 325 or whatever that comparable is. And like you said, it's going to feed on itself. And I think it has a very deflationary movement to it once it starts getting going. And I think the dumping of all these houses by these private equity firms is going to really feed into that psychology and that movement.
And we might even see that same thing in the Airbnb space as well. There's so many of them.
Right, exactly. Yep.
Yeah. So, okay. So, Stephen, historically, it's not the lead up to or the day of uninversion that signals a recession, but rather the bear steepening after when that happens. So now that the yield curve is uninverting, do you expect a rapid bear steepening like in times past and a recession to occur?
Yeah, I mean, a inversion that's followed by an uninversion has preceded every single recession in the United States for the past 50 years. So that's a pretty good long track record right there. There's always exceptions, but we don't believe this one will be that time. Now, the variability of lead up into when the recession starts is the big question. But now that we've uninverted, the countdown is on, and you just mark your calendar every day as we get closer and closer. You look at a lot of statistics today and they say, well, the economy's hanging in there. It's not too bad. But that's because the stock market is near its high. And usually stock market is a leading indicator of the economy. So you want to know when a recession is going to come, watch the stock market. When the stock market rolls over and starts declining in a precipitous manner, then you know the economy is not going to be far behind.
And I think, going back to World War II, the Fed has always said that they are achieving a soft landing. I think the media has always carried that water, that the Fed is achieving a soft landing. A lot of people believe that we have a soft landing today. And, I guess you're in a soft landing until you're not. So,
That's right.
So we're in a soft landing because we're not in a hard landing right now. But is the clock ticking until the long and variable lags actually, crash in? Yeah.
And so you've got the uninversion of the yield curve after it inverted. Another place to watch that has been in the news a little bit lately is China. And in our estimation, China really is in a deflationary spiral. Now they've had these record stimuluses to try to increase demand, and their stock market over the last couple of weeks has shot way up. But I think this is just a short covering rally. And what's happening is the deflationary effects that are already in place in China, I think, are to be exported across the world because, as China exports their goods and services to the United States, to Europe, and so forth, they're doing so at lower and lower prices to try to boost up their exports because their economy is in such bad shape. So that's another area that's maybe not on people's radar that I think is very important that we've been writing about in our newsletter and our discussions with our subscribers is China is really leading the way in the global economy, but that lead is into a deflationary environment.
So, Stephen, global liquidity is back on the rise, which theoretically should stabilize global economies and reduce recession risks further. However, liquidity did rise in 2007 through 2010, and yet we had the great financial crisis during that time. When the liquidity cycle turns up, is it because the central banks are becoming more accommodative to prevent a recession? And in your estimation, does it guarantee that a recession won't occur just because liquidity is rising?
Yeah, liquidity is it's an ephemeral state of mind. It's there until, like you said, until it's not there. You think you have liquidity until someone doesn't want to hit your bid. And then all of a sudden liquidity disappears. And so I think if you're going to focus on liquidity, you got to focus on market psychology, which is what we do. And you can really get a good sense of when people's optimism is starting to morph into a more pessimistic trend. And that's when liquidity is going to dry up and, you're going to try to offer something for sale and the bid's going to keep going lower and lower and lower. I don't think that liquidity is the key driver. I think it's a manifestation of how people feel. When they're upbeat and they're happy, liquidity is plentiful. They buy stocks, they start businesses, they listen to happy music, hemlines go up. But when they become pessimistic, they become more cautious. liquidity dries up, music gets more dour, stocks go down, people pull back. So that's kind of our 3,000 or 30,000 view of how this process works out.
So psychology is the lead horse here, pulling everything else, basically.
Right. Social mood precedes social action. You have to have that mood first, and then people act on how they feel.
Yeah. So we've been in an animal spirits kind of a market here for quite some time. So you're sensing that the animal spirits are starting to dour.
Yeah, I think they've gotten to the end point. Everything has a trend and a limit. Actually, I shouldn't say it has a limit, but it has an excess that it moves to. And that excess tends, when it gets to a point of exhaustion, stop and reverse and move in the other direction. It's just a natural cycle, actually, of, like any natural cycle on Earth. It just happens to manifest itself in human beings. And so I think we are at the end of this optimistic extreme. You can see it in a lot of the indicators. Small traders are pouring into options. You have zero DTE options, options that expire that day that you can buy. I mean, all crazy things that are occurring in the market that show a wild excess of people wanting to speculate. And again, wanting to speculate isn't bad in itself. It's when it becomes an extreme that you have to be careful. And I think we are at that extreme right now.
And oftentimes when it reverses that trend, it mean reverts. And when it mean reverts, doesn't it shoot past the mean first before coming back to the mean?
Yeah. So it moves in a patterned way. And depending on where we are within that pattern, you're going to go way below what historically has been a mean. So I think the next bear market is one that's going to surprise a lot of people. I think they have to be prepared for it. There are certain strategies that we've been employing that have been working even in with this market rallying, and it's really important that people, I think, get a sense of where their portfolios are and think about safety.
So when you say surprise, you're saying severity surprise?
Yes, I think the severity of the market's decline, both in the duration and in the length of it and how big it is going to surprise a lot of people. People, when they think bear market, they think 20% down, 25, 30. I think this decline that's coming is going to be larger in percentage terms than the decline that occurred from 2007 to 2009. That was about a 55, 58% decline. I think this next bear market is going to be larger than that one.
Wow. So Warren Buffett, he sold well over $2 billion worth of Bank of America stock. I don't even know where the number is at this point. And after his most recent sale, he's now below that 10% ownership level. He doesn't require public notification of his buys and sales of his stock anymore. He could basically now sell undercover without any press coverage. Yeah. Last week, Bank of America had some kind of cyber issue. Customers couldn't access their money. Many reported that their accounts showed a zero balance. Is Bank of America on some shaky ground here, potentially facing some level of collapse? And if so, do you think that could even set off some kind of cascading effect within the banking system?
Yeah, well, I'm not sure. I don't know if I'm expert enough to talk about Bank of America specifically, but I can say that the banking sector in general has a lot of their portfolios still underwater because they were locking in these low interest rates at basically 0 to 1%, and as rates rose, that entire portfolio that they own is now underwater and is not coming back above water anytime soon. So I keep looking at statistics that say a lot of these banks have some problems in that area. Now, whether it's Bank of America specifically, I can't really say, but I think the banking sector itself is going to go through some problems as interest rates keep adjusting and moving around. So that's not a sector that I really want to be concentrating heavily in at this point.
Yeah, but how much of an impact, aside from an investment perspective, how much of an impact could that have on everyday life?
Yeah, I mean, look, banks have no money. I mean, you bring your money in, they deposit and they lend it out, and they have, if everyone went into a bank today and wanted their money, their dollars, they couldn't pay you. So you have to be very, very careful about where your money goes and what bank you put it in. Bob Prechter wrote a book, Conquer the Crash, and in the back of it, he lists some safe banks that you should investigate that we've looked at that we believe are going to, you'll be safer at least for a while because these banks have good foundational and depositing structures. But yeah, this is a problem for individuals. And if you have your money spread around in a lot of these banks, you really have to sit down and go, okay, what do these banks look like? And we're starting to see these problems crop up in Bank of America. Earlier in the, we had the problems in SVB and the bankruptcies and those types of banks, those mid-tier banks. But I think the entire banking system has to be looked at and potentially is going to be a problem down the road.
So, Steve, Ken Griffin of Citadel Advisors, he recently sold millions of shares of NVIDIA. NVIDIA's CEO, Jensen Huang, he's been selling regularly. We know that, aside from Bank of America, Buffett has been selling Apple. He's been selling other positions. And Buffett's insurance guy, Ajit Jang, who's been with him for like 40 years, he sold his entire Berkshire stake. Other wealthy, like billionaire level wealth individuals from Druckenmiller to Soros to Bezos, they're selling massive quantities of equities as well. What should we take from all this major selling in the equity markets by these whales?
Way back, way back when I first started the business, I was working for Merrill Lynch, and the chief technical analyst there was a guy very famous named Bob Farrell. And Bob Farrell had a saying. He goes, "There's a lot of reasons why insiders might want to sell their shares, but one of them is not because they think the price is going to go up." So we don't know why insiders sell, but the fact that they are, or that big holders, whales like this, are selling should be a signal that the big money, the smart money, the Druckenmillers see some problems down the road. They're looking to raise cash. And cash is something that we've been talking about at Elliott Wave International for several years now. 2-year floating rate notes and 3-month T-bills have done extremely well over the past several years. Now, the return is lagging the return, say, of the S&P 500, but you're compounding. The 3-month T-bill is still at 4.6, 4.7. You're compounding at 4.6, 4.7%. Tax-free or risk-free, really. So that's very attractive to us, to be in a risk-free environment where you can get your money. It's short-term, and so that you have the opportunity to move into different areas as we see opportunities. But the fact that the big boys are selling too we all should take notice of that.
So from a market capitalization to GDP standpoint, in 1929, the ratio topped at 109%. In 2000, it topped at 130%. And in 2007, it topped at 105%. These were all major inflection points in the market and in our economy. Today, the ratio is around 200%. Would you share your perspective on what this ratio level means and what our takeaway should be?
Yeah, in fact, we just published a chart of this ratio in our most recent issue of our newsletter, the Elliott Wave Financial Forecast. So this is the first time in history that stocks broadly have been valued at 2 times the GDP, the ability to generate the income needed for that. And it means exactly what you think it means. It means an historic overvaluation for stocks relative to the productive assets within our economy, GDP. This is just one more measure. We have pages of valuation measures that show how just crazily overvalued this market is, and this is one that we just showed to our subscribers. It's one more sign to us. Besides the psychology, you need that bullish psychology to get the overvaluation, to get to be 2 times GDP, and it's just one more sign to us that we're at the end of this trend.
I want to point everyone over to our Substack. It is free. Go to metalsandminers.substack.com. We post free content on the consumer economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one. They're all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on an important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History nor Economics." This free gift is a must-read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive the free gift on us. Also, I'm positive that you've enjoyed the conversation with Steven as much as I have. Please let him know by hitting the like and subscribe button and leaving a comment below the video.